Thank you all. Hello. Thank you all for joining today to the New York stop of InsurTech Connect's World Tour. Title of our stop is How to Become an InsurTech Unicorn. Very excited about today's event as we have an amazing lineup of speakers today. So first, a bit about who we are. We're InsurTech NY, a community-based organization where our mission is to drive talent to insurance, support innovation-friendly regulation, provide infrastructure to startups, and improve access to investment. Our mission is executed through three things: events, which is one of the things what we're doing right now. We also have a job fair, and then we also host global InsurTech competition as well as a growth stage accelerator. First, I want to thank our platinum sponsor, EY, for helping make this event possible. EY helps insurers solve their toughest challenges and realize their greatest ambitions, but drawing on their shared creativity, experience, judgment, and diverse perspectives to reframe the future for their clients. So one question you might have if you joined our event is, what is an InsurTech unicorn? So we defined it. So this is our definition. So basically, first of all, it has to be a startup that's insurance focused. They could be selling an insurance product or potentially helping insurance companies do that. Yeah, we had to, we only looked at, we defined an InsurTech startup as a company that's recently been founded. So we probably define an InsurTech only if it was founded after 2012. There's a lot of other InsurTech-ish companies that's been around longer, like Guidewire, obviously, but we wouldn't consider them a startup. So we wouldn't put that as a InsurTech unicorn. And then finally, you would define an InsurTech unicorn as a company that has approximately $1 billion in valuation. And this is based on our estimates based on their last known round of valuation. Plus, if they were to be valued now, will they be close to $1 billion in valuation? And so based on this definition, we found 10 InsurTech unicorns in the US. And you see those 10 logos right here. We basically, what we did is we looked at all these 10 companies to see if there are any interesting patterns that could help us understand them a bit better. And by the way, the check marks you see there, Hippo, Metro, Mile, State Title, you'll hear from their CEOs in a few minutes. So some interesting patterns. So first of all, in terms of sectors, we found that there was actually many of them were in the P&C sector. So they focused on actually selling insurance, P&C insurance products. And then we also saw 3 healthcare related startups, and then finally benefit startups. What's interesting is that there are no InsurTechs, at least in the unicorn status, that were in life, annuity, or actually B2B solutions. So we didn't see any that were providing optimization process type of software for claims, underwriting, things of that, distribution, things of that nature, yet in the unicorn status. Second is, what's interesting is 9 out of the 10 startups are actually full stack carriers. And another kind of interesting things, many actually did start as MGA, but now either through getting their own license or acquiring other carriers, they're all full stack carriers now. And third thing is we looked at their founding team, and in the PNC side, most of the founders actually came from a non-insurance background. So in other words, they didn't work for a traditional insurance company. And so that was kind of interesting. But on the other hand, on the health side, all the founders had some kind of health or medical type of background. Probably shows that probably there might be a higher barrier to entry on the health end. And in terms of the legacy insurance involvement, they actually, the incumbent insurers have been very active, either as a capacity or license provider to many of these InsurTechs when they were an MGA. And they still are acting as a reinsurer for many of these InsurTechs, and in often cases investing in them either early or in later stages. And all of them have been active mentors as well. So there's a lot of collaboration amongst InsurTechs on the InsurTech unicorns as well as with the other insurers. And then finally, in terms of investment exit, we saw that a lot of them have participated. There are 210 who invested in all of them, but there's only a few who actually were able to identify multiple unicorns. So there are about 25 who actually were able to kind of invest in multiple of them. And finally, there was one IPO, which is Lemonade. So things to watch out for in the future. The question you might have is, will there be any life or annuity-based unicorns? And will there be any B2B solution providers who kind of rise up and grow to be a unicorn? Another question you might have is, will we continue to see non-insurance background founders be successful, or are you going to see some traditional insurance experts and leaders kind of joining the InsurTech ecosystem and building their own startups? I mean, we already see many insurance people starting startups, but we'll wait to see if they will actually make it into unicorn level. And what will be the involvement of the legacy insurers? Will they increase, decrease, or stay the same? Our guess is that it will likely increase, considering that many still haven't actually been too involved working with InsurTechs, or some are actually in the very beginning stages of it. And finally, we'll see more IPOs. We believe so, but it remains to be seen exactly when that will happen. So hopefully that was some interesting insights for you guys. And we'll hear more from the panelists of the CEOs of some of these InsurTechs later on. All right, so one quick announcement before we get to the rest of the agenda about our upcoming event. We're hosting an InsurTech virtual matchmaking expo on October 29th. I don't think we've seen anything like this hosted anywhere else. It is a event to help InsurTechs identify their advisors, board directors, and full-time roles. It will be a chance for anyone who's interested in helping or joining InsurTech to attend this event to find that ideal InsurTech they want to help. So just quick key highlights of our expo. There will be 60 InsurTechs across all stages. There will be 400 plus open roles for advisors, board directors, and full-time employees. Just note that there's only space for 500 people, and that includes the vendors or the employers. So our guess is that this will sell out, so please register fast. And finally, it is a real expo-style virtual experience, and I'll explain what that is. I'll show you how it actually works on the floor, but there's going to be 5 floors, 60 booths, and 30 interview tables, and obviously a lot of people joining the event. I'll show you how it actually works. So if you actually look at the video right now, you're seeing how the actual expo will look like. This is the first floor, and you see a lot of different company names on there, and these are the employers, the InsurTech employers. So you see me on the first table there with Brightcore, and basically they'll be represented there, and you can kind of talk to them. And as you can see, the video kind of working. I'll be kind of hopping from one table to the other, so you can kind of see how that works. So now I'll be moving from Brightcore table to the InsurTech NI table. And once you do that, you'll see a video pop up. There's Stuart representing InsurTech NI, and we can have a chat, audio, videos up, and you can kind of talk. You see me waving, and that's how you can kind of communicate. And you can also hop onto the interview section where I'm having a conversation with David, and we can have a private conversation and nobody can kind of listen in. On the left-hand side, you also see the elevator, so you can move to a different floor, and you'll see me moving to the second floor where there'll be a host of new companies who will be available to talk to you about their open roles. So that is kind of the overview of how the expo works. Hopefully that gives you some kind of idea of how it actually can work. All right, so just finally, hopefully that makes sense. We'll be sending out an email with how to register for this event. For now, if you want to register now, please go to our website, insurtechny.com, and register there. Great. So now I am very excited to share the agenda for the rest of the day. So today we have two exciting speaking sessions for you. The first is a startup showcase where you'll hear from 5 startups with high growth potential, and you actually get to vote. So my partner David will be actually sharing the link to the voting shortly, if he hasn't already, in the chatting window. And you'll hear from Goose, Honcho, Motion Insurance, Bonza, and Boom. They are also actually 5 of the 33 InsurTechs who have been selected into our accelerator program. So very excited to hear from all of them. And then we're also hear from CEOs of 3 of the InsurTech unicorns that we just went through. And we'll hear from them about the recipe for building an InsurTech unicorn. And then we'll wrap it up at 11:45 a.m. Eastern Time. Great. So now I'll hand it off to my partner, Brett, who will do the introduction.
Thank you very much, Tony. And as Tony said, we've got 5 great startups today in our showcase that have some real unicorn potential. And as he mentioned, we're going to be featuring Goose Insurance, Honcho Markets, Motion Insurance, Bonsai, and Voom Insurance. And to start it off today, we have Dion Merkovic. He is the CEO of Goose Insurance. So Dion, if you could take it away.
Hey, Brett, thank you so much. My name is Dion. I'm the co-founder of Goose Insurance. And we're an InsurTech challenger. Goose is consumer focused. We're not a marketplace or comparison site. Rather, we provide consumers with a unique Goose policy across multiple lines of insurance. Our policies are super simple to understand, and you don't need a broker to get coverage. You can do it yourself in minutes through our self-serve super app. At Goose, we're betting that in the next 10 years, a fundamental shift will occur in how consumers buy and interact with insurance products. Consumers will move away from legacy bricks and mortar broker channels and clunky online experiences to a mobile-first self-serve platform. Our super app enables the world's 5 billion smartphones to become personalized insurance storefronts. Think about it. We do our daily banking on our smartphone. We shop, we order food. We even talk to our doctor through our smartphone. It's now time for insurance. At Goose, we're solving 3 interrelated consumer problems. The first is knowledge. Most consumers are simply unaware of all the lines of insurance to protect themselves, their families, or their assets. Missed markets. Massive consumer segments such as middle market and low-income consumers have been underserved by today's distribution channel. And finally, accessibilities. Consumers want instant access to everything. Our whole lives can be run on our smartphone. To solve these industry problems, we've built what we're calling an insurance super app, a mobile-first platform supporting both iOS and Android and a proprietary backend. Our vision is to enable any consumer to self-serve any line of insurance they may need. Consumers can access multiple lines across both P&C and life categories all in one app. Our super app makes insurance a tangible consumer product, and most importantly, it makes insurance consumer-friendly and convenient. At Goose, our app does just more than sell insurance. Consumers can discover new lines of insurance. Through video, they can educate themselves about policies. And leveraging data, Goose will make personalized recommendations to each consumer. Consumers can get quotes instantly. We have rules-based underwriting that occurs real time, and policy benefits are clearly explained. Goose also upsells complementary lines of insurance at the time of quote. Purchasing a policy is simply as entering your payment details and you're done. Policies are fulfilled in our super app and email. Are consumers willing to buy insurance from an app? We're happy to report that we've achieved product market fit with over 33,000 consumers becoming Goose members. Solving underinsurance and accessibility to underserved markets is a $1 trillion opportunity. It can make or break a new unicorn. So who needs a super app? Just in North America, we estimate that there are hundreds of millions of consumers that need access to insurance. Our business model, we're digital MGU. We generate a recurring level commission for each policy. Our policies are exclusive to Goose and only available in our app. We don't take any risk, rather we partner with insurance carriers and reinsurance providers. Our unicorn roadmap is well-defined. Our aim is to acquire 1 million Goose members and provide them with $500 annually of insurance per member. This is not our first rodeo, or should I say InsurTech. We founded Square One, Canada's first and largest InsurTech with over 125,000 home insurance policies in force. We're domain experts. We have over 50 years of experience in building insurance products, and we have over 20 years of experience in mobile. We're here today for two specific reasons. We're looking for partners to underwrite our lines of insurance, and we're raising capital. Please reach out. Thank you so much.
Thanks a lot, Dion. I appreciate that. Next, we've got Gavin Sewell, is the CEO of Honcho Markets. So Gavin, if you're ready, please take it away.
Thanks, Brett. Hi, everyone. I'm Gavin Sewell, and I'm the Chief Honcho at Honcho Markets. We are a UK InsurTech operating the first real-time reverse auction marketplace for the distribution of insurance products. In the highly competitive consumer and micro SME insurance markets, we help our customers avoid underinsurance by identifying the protection that they need. And at the same time, we allow our insurance partners to target the best customers, optimize their product and price point to those customers' exact needs in real time, so that they win premium business whilst reducing their distribution costs. So we combine the price efficiency of an eBay auction with Amazon-style product discovery. In markets where price comparison websites have significant traction, insurance product distribution is dysfunctional due to the belief that cheapest product is best. PCW messaging and cheapest first product selection user journeys drive customers to buy poor products that underserve their needs. To sell on these platforms, insurance providers hollow out their products to be able to compete on price alone. This problem is further compounded by PCW's high commission levels and practices that increase customer churn and therefore reduce customer lifetime value. To address these problems, we have built an open, transparent, and equitable distribution marketplace that encourages the optimization of product and price to a consumer's specific need whilst increasing transparency and reducing overhead. Through our apps, we take the customer on a fun and engaging digital journey to understand their protection need, and we replay that need to our insurance partners. We encourage insurers to only present a product solution to customers where it well serves that customer's need and at a competitive price. Then we give insurers real-time visibility into how their product performs against their competitors' products in terms of both coverage and price, and we allow them to optimize their offer in response in real time. And our pay-to-play commercial model allows insurance partners to distribute cost-effectively and share the economic saving with customers. So we currently operate in the UK motor market. It's a £10 billion market, and we're working to expand our product cover to include the rest of the £20 billion general insurance market in the UK before expanding internationally. Our platform has been built around reusable APIs to allow our product to be tightly integrated with other marketplace ecosystems. And we have partnerships at various stages across banking, personal financial management apps, employee platforms, and digital motor propositions. We also operate a Honcho branded product supported by digital marketing and affiliate partnerships. Our commercial model is highly differentiated. We do not charge commissions. Instead, we charge insurers £1 to enter a customer's auction, giving them access to a live competitor market data, as well as the possibility to win that customer's business during a 28-day window. We generate additional revenue through partnerships and insight data. Since launch in 2019, we have signed up 16,000 users who have run over 22,000 auctions for insurance worth £32 million in GWP. We have 30 insurance brands live and multiple ecosystem partners. Our senior team is comprised of financial services professionals. Only one of us has a background in insurance, which we consider to be a significant advantage in the insurance space. And between us, we have built and exited multiple fintech startup businesses. Since inception, we have been well supported by angel, crowd, and VC investors, as well as having won places on accelerator programs, including Tech Nations, FinTech 2.0 in the UK, and InsurTech NY's Growth Accelerator in the US. We have launched our motor marketplaces and are working on additional product lines, as well as researching international expansion, and we will be raising a Series A next year. We are looking for additional insurance partners to join our platform, and we are keen to discuss our upcoming Series A with global investors. So many thanks for listening, and you can find out more about Honcho at gethoncho.com. Thanks very much.
Very interesting, Gavin, and we look forward to hearing more about some of your upcoming successes, not just in the UK, but around the world. So very exciting. Thanks again for sharing. Next up, we've got Motion Insurance, where we've got the CEO today, Jason Wooten, and he will be displaying his company today. If you're ready, please take it away, Jason.
Thanks, Brett. So my name is Jason. I'm the CEO and co-founder of Motion Auto Insurance. We're not your typical auto insurance company. With a deep experience in the industry, we decided we were going to look at this a little bit differently than what we've seen before, and that was to partner deeply with the OEMs and be fully embedded inside of the vehicles themselves. So with the experience that we have, we took a look at the entire industry as an overall whole and said, okay, let's look at this from the consumer standpoint and try to understand how we can best achieve our goals. So we first, on the left-hand column, took a look at a lot of the competitors in the insurance space and noticed that the number of questions to get it right is astoundingly long. The second one in the middle there was, we realized that there's a significant number of shoppers online. This number hasn't decreased. It's increased year over year, going back almost 10 years. Interestingly enough, very few individuals who are doing this can actually buy online. That's about 18%, where we know about 82% of them wanted to buy online. And then in the last column on the right-hand side, we took an example in the state of Arizona. We did a one car, one driver quote. It generated 21 different rates from different carriers. And we saw that rate discrepancy of over 250% from the least expensive to the most expensive. So as we started to collate that together, we realized there's a couple of things we want to do here. The first is we need to eliminate this lengthy quoting process. There's significant amounts of data available in the marketplace. Let's go use that. And so we do today. We're excited that in the next week, we will now launch our next version of our quoting portal, which will consist of just simply 5 questions. The second one was, again, a lot of people can't buy online. And the current customer set we have, about 90% of our customers do buy online. But as we continue to expand in geographically, we also want to make it agnostic. If they want to buy online, great. They want to buy from an agent, great. From the bank, yes. From a dealer, great. So wherever the consumer would like to purchase that's best for them, that's where Motion wants to be. And then in the third one, this is the most exciting one for us, was these discrepancies in rates are usually an offset of a long-standing book of business that's been there for 70, 80, 90 years. Well, the new world has come and introduced a thing called telematics or driving data that allows us to put safety and control back into the customer's hands. So the market's very large for auto insurance in the US. It's the largest market for auto insurance on the earth, $285 billion, a subset of a $1.2 to $1.4 trillion market in the United States today. There's over 276 million vehicles in operation in the road as of the end of 2019. So the overall market is exceptionally large, and we don't see that shrinking very much over the next 3 to 5 years. So how are we doing this today? There's 3 unique channels that we're focusing on. The embedded channel, which is right into the dash of the vehicle itself. We're doing that with a very strategic partner of ours called Telenav, who happens to also be an investor, publicly traded organization that gives us access to tens of millions of vehicles on the roadway today. We'll talk about that more in just a moment. Strategic partners is another avenue. We've got over 5, 6 dozen partnerships that we integrate directly with to try and present the insurance at the right time for the right moment for that customer. And the newer channel for us is harkening back to my own personal days, which is in the agency and broker network channel. We've got access to over 80,000 agency brokers across the United States to cherry pick the ones that we want to work with. So I mentioned Telenav, and I'll spend just 30 seconds on that. Telenav is an exciting relationship for us. It brought us a number of different things. The first was access to 25 million vehicles and growing by over 1 million vehicles a month. This includes telemetry data at the raw level, over 1,300 data points per second. The second was it became an investor, which as a CEO is always exciting. And the third is the launch of their in-car commerce marketplace system that they've announced publicly several times in their earnings calls, called Vivid, which will allow us to integrate and access the vehicle's data as well as interact with the consumers right inside the dash of the vehicle and almost a dozen different OEMs in the US. The team's a very seasoned team. I've spent over 18 and a half years within the industry. Down to the bottom right, we have Denise Ross. It comes from a number of large tech carriers. And we are a heavy InsurTech, tech-related organization. And so we have a heavy set of number of technologists inside of the team as well. We are raising a Series A at this particular time. We're hoping to close that out by the end of this year. Thank you. We appreciate your time.
Well, I saw Jason. Very interesting, and best of luck on that Series A coming up. Our next startup showcase company will be Bonsai, and Steve Sherlock, the CEO, will be presenting today. Please take it away, Steve. Looks like you're all set.
All right, thanks very much, Brett. Hi, everyone. Steve Sherlock's my name, and at Bonsai, we're all about on-demand mobility insurance, with an initial focus on solving the problem for non-owners while they rent or share cars. Now, Angela is a typical customer who doesn't own a car, though she's planning a road trip with a rental car. She's going to drive from the Bay Area over to Nevada, Utah, Arizona, and then back through Southern California. Sounds like a great adventure. Brett, can you hear me?
Yep. Let me see. Tony, can you forward that slide?
No, you're right. You're right on the right slide. So Angela's biggest concern right now is about the insurance risk. It's about the insurance risk given the different laws across the various states. She just wants to, She just wants to enjoy the trip without worrying about what if she has an accident. I think we got a technical issue. Can you hear me?
We can hear you fine, Steve, and we're on your third slide, the solution slide. Can you hear us okay?
Can you see the slide, Steve?
Yeah, okay. Yeah, so we're on the third slide. So through the Bonsai app, Angela's able to tap the screen just a few times, and within 2 minutes, she's done. In this case, she bought a primary liability insurance covering her across every state up to the state minimum, and a supplemental liability, which gives her coverage up to $1 million in aggregate coverage, and all for $1 per hour over a 24-hour period. Now, even though we sell damage insurance, Angela has chosen to use her Platinum credit card instead, which is a smart move. And upon her return, Angela gave us a 5-star review, just like 400 people have already done. And in this review, there's a real review from a woman called Angela. Now, frankly, our customers love our products, but it's not about the products, not about the technology. It's not even about the insurance. It's really about their quality of life. Now, customers like Angela, they're able to insure rental cars, shared cars, and also peer-to-peer, like Turo. And coverage is available in 50 states and Canada. And anyone from around the world can also buy these policies to consume in Canada or the US. Now, the rental car market is worth about $36 billion in 2019, and the car share market about $5 billion. Obviously, both of these categories have taken a hit due to COVID. Around 2 billion of this of insurance has been sold into these markets, and the accessible market to us is around 1 billion, and we have a detailed plan on how to scale our sales and revenue. I'm an insurance agent licensed in 50 states, and I haven't owned a car in 14 years. So as an agent, I had to work out for myself what insurances I needed personally if I wanted to have peace of mind. And once we worked that out, then we were able to build that into our platform. And to date, we've sold $1 million in premium and 19,000 policies. And what gets me really excited is that since June, 40% of all the policies sold on our platform were liability. So that tells us that we're really solving a problem that people have. And eventually we'll aggregate on-demand mobility insurances around the world. Now, we didn't stumble into this idea. I founded one of the world's leading car rental aggregators and exited that industry in 2012. But at the same time, people were constantly complaining about insurance related to rental cars. So our next venture was with my brother in 2012, where we created the very first on-demand rental insurance policy in the Australian and New Zealand market, and we partnered with Allianz to achieve that. And in 2017, we basically replicated that model in the US and made it fit to the US laws. Dario is a friend of mine and a trusted advisor, a very high level experience with Gallagher and Aon, and super smart in the insurance space. We've self-funded to this point for around $400,000, and we've used our money wisely with a long-term freelance team, and we're a profitable business, albeit on a small scale. We're raising a seed round of 1.5 million, and we'll build out our engineering team and our distribution platform. We prefer investors that have got distribution experience and where there's a good cultural fit. And we have a realistic opportunity to underwrite as well for products that don't yet exist. Just to the last slide. And so that's it. Thanks for your attention. I just want to finish off on this point, that anyone renting a car who doesn't understand the coverage options, particularly millennials, they are rolling the dice with their future. And if they don't have the right coverage, as a non-owner, I feel it's our obligation to mitigate that risk. And that's pretty much why we're doing what we're doing. All right, thanks, guys. Back to you.
That was great. Thanks, Steve. And last but not least, we have VOOM Insurance. And Noah Urbach, who is the VP of Business Development, will be presenting today. If you're all set, please take it away, Noah.
Thank you. Hi, everyone. My name is Noah, and I'm VP Business Development of VOOM. VOOM is a digital MGA that creates innovative insurance products for the next generation of mobility. We operate today in 4 countries. We sold already tens of thousands of policies, and we work with leader insurance carriers from around the world. As insurance for mobility experts, we notice that the entire mobility ecosystem is moving much faster than insurance. We've identified 3 main trends. The first one is new vehicle types. We are seeing new vehicles like drones, e-scooters, and e-bicycles. We're also seeing new types of utilization. So it was previously a privately owned car that was only used for personal use, can now be used for car share, ride share, and even for deliveries. We are also seeing improved connectivity and safety measures, creating new opportunities for capturing data and connecting with drivers. These new changes are creating challenges for incumbent insurance carriers and a real need to develop new products for this segment. But in VOOM, we believe that these changes are also representing a huge opportunity. VOOM leveraged technology to create usage-based, flexible, and integrated solutions for the next generation of mobility, together with leading insurers. We have live revenue-generating products, as well as new products that we are incubating at the moment for a broad range of mobility categories. Today, I'd like to drill down to a specific case study, our commercial drone insurance product under the brand Skywatch. Drone insurance is a fast-growing category with many professionals and companies using it today. Skywatch and our drone product has become the category leading solution in the US. We are top ranked on Google search organically when you search for drone insurance. We've sold tens of thousands of policies, and we have numerous positive reviews on all apps and Facebook, etc. And we're also backed by the largest carrier for aviation in North America, Star. We've created a simple-to-use app and web platform for users to buy hourly, monthly, or annual drone insurance in just a few clicks. We use telematics as well as contextual data such as location and weather conditions to create personal dynamic pricing in real time. This framework is applicable to any mobility platform. While we pride ourselves with strong direct online acquisition, we've also expanded our reach and developed a white label broker platform, as well as APIs to integrate with leading providers and partners. Lastly, we have developed a unified management system that allows us to track everything in real time. So let's zoom out again and focus on the technologies that we have behind the scenes. We've developed a telematic-based risk analytics engine with the ability to take telematics data, as well as external data sources, apply machine learning, and create a valuable risk score. We've also developed our own next generation, born in the cloud policy management system. And lastly, we have developed an effective digital distribution tools like mobile apps, APIs, and branded portals. Before I wrap up, it is a good opportunity to mention the team in Voom. Voom started as two data science geeks who fell in love with insurance. Today, however, we have a well-rounded team, including insurance and product experts, marketing ninjas, and actuaries. We're also very fortunate to partner with leading VCs that specifically specialize in InsurTech and FinTech. So to summarize, these are exciting times in which mobility moves much faster than insurance. Voom is here to help carriers bridge that gap and help partners unlock new revenue stream in a very confident, data-driven way. If you'd like to hear more, please email me. My email is down here. Thank you very much.
Thanks, Noah. And you should be well received. We're all a bunch of insurance geeks here at the end of the day. So great job, and thank you for presenting. Next, we have our panel today. I'm very excited about our panel. It is titled The Recipe for Building an InsurTech Unicorn. And we have some amazing founders here with us today to share their experiences. Asaf Wand, he's the CEO of Hippo. He is a serial entrepreneur who most recently exited Sabi, a consumer products company. Asaf started his career as a captain in the Air Force and has held leadership roles in the telecom space. Next, we've got Max Simkoff. Max is the CEO of States Title, Portland native and avid surfer. Max started his career and built his first business as a result of a private equity search. Max has built startups in the analytics and HR space. He's also an active angel investor. And last but not least, we've got Dan Preston. He is the CEO of Metromile, a Massachusetts native who sold his first payments company to Intuit. Dan helped pioneer the pay-per-mile insurance category, and Dan was recently recognized as the top 40 under 40 in the San Francisco Business Times. And we're fortunate enough today to have our good friend of InsurTech New York, Rich Brailsford, over at partner at E&Y in the Financial Services Division, as our moderator today. And he and his team work directly with several InsurTech unicorns, including some of those who are speaking on our panel today. So, Rich, if you're ready, feel free to take it away, my friend.
Excellent. Thanks so much, Brett, for that. And first off, Asaf, Max and Dan, thanks for taking the time. I know everyone is very eager to hear from you guys in terms of learning from the road that you've already paved here. So maybe to dig right in, Asaf, I'll start with you. And I think insurance to a certain extent runs in the family. But if you could share some insights on how your father working in insurance influenced you in building Hippo, would be great.
Sure. Morning, everybody. It's a tad early on the West Coast. So morning, everybody. I'll try to come up with some reasoning. I think the main component of the fact that my dad was in insurance was basically psychological. Everything that your dad basically does, you want to prove him wrong. You think it's broken. You think it doesn't make any sense. I remember driving in the back seat with my dad, basically handing over calendars, because this was the way that they used to market to agents. So it's Rosh Hashanah now, so it's the Jewish New Year, and this was the time when we used to get the calendars, and he was very excited, and I used to drive, days and just handing over these calendars. That was the marketing component. And even then, I started having a discussion that I just don't understand why isn't everything moving to the web. Now, the second touch point that I had with insurance a lot more deeply was while I was working with McKinsey in New York in the financial institution group and serving some of these massive carriers and customers. And you realize that almost every component is broken. So you have a certain perception from the outside, but when you actually open the kimono and you see how broken it is from within, that plant the seed in my mind that I really, really need to have something done in insurance.
Excellent. Thank you for that. I guess, Max, to turn it to you and talk a little bit about the origins of your company there. Can you talk a little bit about what you learned in growing your analytics company and the subsequent acquisition that you used to cornerstone the company there?
Sure. And good morning, everybody. Thanks for having me. I guess I'd sum up what I learned from my first experience starting a business is don't invent a market. That's how I'd sum it up. We started what we thought was a fantastic idea, predictive analytics software business to help large companies predict who to hire. And we were probably 5 to 7 years ahead of our time. And we found ourselves, throughout a lot of that journey, trying to convince the buyers in our, what was becoming our target market, chief human resources officers mostly, that they should use data to make better hiring decisions. In hindsight, it seems like a great idea because that market did explode. Unfortunately, that happened, a few years after we really sold our business. And so the key learning lesson there was the market always wins. There's a statement that's been attributed to some famous venture capitalist that's basically something like good team plus bad market wins. Good market plus bad team, market wins. Great team plus great market. That's when you have something special, right? And so my takeaway was I wanted to build a business in a market that already existed where there was a lot of inefficiency. And I found that in the title insurance market, where I'd be happy later to go into just how much inefficiency there is.
Fair enough. And then Dan, turning it to you to give a little bit of background on Metromile, and more specifically, in the first iteration of Metromile, it relied on telematics that represented a new behavior for drivers. And how did you set the stage for the initial interest and demand for this new behavior? If you could share a little bit of insight on that.
Sure. What's interesting is the idea for mile insurance has been around for maybe 100 years. We found this actuarial article from like the 1920s that talks about per mile insurance and why it's the best way to price for insurance. The challenge for those 80 years or so afterwards is that there was no technology to enable what would be a forward-looking or real-time insurance product, something that actually represents the real risk that the driver incurs. And so when we started the company, it was right when all of the mobile device components had come down in cost by several orders of magnitude. And so these devices that we use to plug into the car's diagnostic port became low enough in cost where we could offer that to all of our customers. It's just built into the pricing of the product. Now, all that said, we've been used to proxy-based insurance for our entire lives. We've been used to a 6-month policy based on your credit score, type of car, and some estimate number of miles or whatever you put into the form. And so early on, we actually looked at how could we start to shift the behavior by not actually even focusing on insurance first. Our first iteration, really as an MGA, was taking that same telematics data we were getting from the device and trying to create really exciting, delightful experiences for our customers, and then trying to monetize that product with the insurance product. So a lot of what you see as a Metromile customer are things like avoiding parking tickets through notifications we send you, or diagnosing car issues through the diagnostic data that we get from the device. All of those features came out of our initial approach to how we were introducing customers to the product, which was we are going to first create value you haven't seen before from this product and introduce you to the idea as you're a customer of ours. Over time, of course, as people have gotten more and more used to it, people suggest it to their friends, the idea of paying for only the miles that you drive becomes more obvious. And of course, as people get more and more used to entirely digital products that are more real time in this way, I think it becomes more obvious as it grows. But it's been an exciting journey as we've kind of first and foremost on that customer experience, what makes people really excited to join in the first place, and then kind of introduce them to insurance over time. But it all comes out of that initial opportunity from being able to see that from data.
Excellent. Thank you. Thank you for sharing that. I guess moving into thinking about the early days of each of your companies, Asaf, turning it back to you in terms of how did you end up going about and approaching building out your initial team, the board, and complete fundraising prior to having some of your reinsurance and licensing in place? Can you talk about that?
Sure, happy to talk about it. Rich, before I'm doing it, is there any chance we can actually leave this format that we're just seeing a slide? Can we move to video or something? It's not very engaging just talking to yourself on a slide. That would be helpful as well.
Yeah, Asaf, just so you know, this is being live streamed in a different format from what you're seeing. And right now, you only see 4 speakers.
Yeah, but is there a way to shift it to a video? That would be, otherwise I'm going to fall asleep talking to my to my own slide. Try at least see people and then live and then movement. That would be way.
There we go. That's better.
Just seeing the smiling face of Max is way better. Appreciate it. Thanks. Okay, now let's get to your question. So the question is how you build the team, the investors, etc. So I think it's a gradual thing. That's the main answer. In different phases of the company, you build different components of the team. At the beginning, the people that, the team, you bet on, basically people are betting on you rather than you betting on them. They're doing you a favor. You're trying to overhire to the level that you have. The only, I would say, the only currency you have is actually title. So you're giving people that probably should have been an engineering manager, they're the CTO of the company, and it's fine. That's just how it goes. That's the only currency that you actually have. And the first investors are usually the ones that basically doing you a favor, because when we pitch, just a second, my dog is just out.
No worries.
Yeah. So the first kind of people, when we pitched, then all of the stuff that we pitched that was an issue became an advantage later. So when we came up, everybody told us that insurance is not a VC-able business. It's highly regulatory. It takes forever to file. People wouldn't want to buy. It's a massive TAM, but all of the current competitors have bazillions of dollars and stuff, all of that. And then when it flipped and we actually came to market and this whole wave of InsurTech came, all of these became really, really awesome. So when we pitched, like, that's awesome. It's highly regulatory and you already passed that. You know that you filed and then it's already approved. Every component that was a negative became a positive. And the hard thing was to find the initial investors. We were fortunate enough to have a fund called RPM, and it was even more specific. We found a partner. His name was Adam Boyden. Adam used to be one of the founders and the COO of SoFi. And it was the closest thing that we could kind of like, listen, we're going to do what SoFi did for basically student lending. We're going to try and do something in insurance, and we're going to get scale and distribution and all of that kind of stuff. So he kind of got it, but it wasn't an easy funding. By the way, any funding is always a lot harder. It's always very, you look at the everybody announcement and you're like, I can't believe this guy just raised. It's always a lot harder because you want to find the right valuation, the right investor, the right term. It's a lot harder. But it's a gradual thing. You start with a small team and you hire up as you move along. One more point that I wanted to mention is one of the first hires that I had to do was basically a VP of product. Now, it might sound trivial, but most cases in technology, basically the business partner is the one who's doing the product and the business development kind of thing, and the other technical founder is doing the technology side. In our case, because we didn't understand enough about insurance, I had to actually build the insurance product, which means find the reinsurance, set up the MGA and all of that. And I needed someone to actually look at the consumer-facing product. So we hired a VP product, which is actually still our chief product officer right now.
Gotcha. Thank you for sharing. I guess, Max, turning it to you, early on, you made an acquisition of a company that was much larger than States Title. Can you share with us how you went about this and achieving this accomplishment?
Yeah, and actually, I will answer that question in a second. I want to add on to a few things that Asaf said.
Oh, sure. Yeah,
that I think are really important and also personal in a way, in a really positive way. I think because I know there's a lot of founders probably that are watching this, and one of the things that I wish somebody would have told me, and I learned through luck at the time in starting a business in this space, was meeting other founders. And I met Asaf in probably late 2015. And I would say that like meeting him and several other people who I'm just amazed at the businesses they've built. It helped me get the confidence to start a business in an industry that I had absolutely no background or understanding in, right? I don't know insurance. I don't know real estate. I certainly didn't know title insurance. And you just never realize until later that the people that you meet who are founding other businesses in that space, there's just this like an obliteration of a learning curve that comes from actual like lack of knowledge. And it sounds weird. It's like, you can go and talk to a bunch of insurance people and they're going to tell you all the things that can't be done. And I probably heard a lot of the same things that Asaf did when I thought about launching our business. I talked to people who were like, there's no way you will ever launch an insurance carrier. You have no insurance expertise. You'll never get approved by the Department of Insurance. They're going to run these biographical affidavits. You need surplus capital on your balance sheet, blah, 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 right? And then I went and talked to people like Asaf, and he was like, absolutely, you can do it. Like, here's how we did it. Here are the mistakes we made. Here's how you could do it faster, right? And so I think that's an important thing for people in the founder community to realize that a lot of times the most valuable connections you're going to make that will help you build your business in the industry you're building it in are other people who are building their businesses, who, by the way, are just as clueless as you are in a good way about, how to figure things out. So it's one additional thing. I mentioned the only regret, as Asaf knows, is that at the time that I met him, he made a seed investment in States Title, and I neglected to do the same in Hippo, and I've regretted it to this day. But it's water under the bridge, I guess. He'll make plenty of money on his States investment. On the question about acquiring North American Title, how did we pull that off? It kind of on the similar theme, like we were just like really driven, and we were pretty naive. Like, if you talk to people at the time, experts, investment bankers, people in the insurance space, and we would have asked them, hey, we're a 25-person tech startup with less than $300,000 of revenue, trying to go and do both a divestiture and an acquisition of a subsidiary of a publicly traded company that will in and of itself have close to 200 million in revenue, including a 40 state, fully capitalized, fully licensed insurance carrier, they would have been like, there's just no way. Right. And I just keep coming back to this theme of like positive naivete, right? Like people tell you it can't be done, like screw them, right? Like those are all the people that don't build transformational businesses, right? And we found a willing partner with Lennar. They were willing to get very creative because this was a part of their business that they realized they could unlock value in by having it combined with a more entrepreneurial management team. We structured a super creative credit facility, basically seller financing for us to buy the majority of the business. And then we transacted some of our own much more valuable equity at the time, more valuable than previous rounds that we'd raised. And then we just made it work. And again, we made plenty of mistakes along the way. It's probably a whole separate webinar to talk about where we stubbed our toe and some of the things that we did wrong. But luckily, we did more things right than we did wrong, and it ended up transforming our business.
Excellent. And Dan, I guess turning it to you to share some insights, around the early days and getting over some of the regulatory hurdles. When you started Metromile, the pay per mile concept was not really common. So can you talk a little bit about how you overcame those natural regulatory hurdles to get the programs ultimately approved?
For sure. I mean, I do think that a lot of what Max and Asaf shared resonates a lot, just in not necessarily taking the advice at face value, but just looking at it from more of a first principles approach. And asking the question, what is it that we're trying to offer? What is insurance supposed to do? And what are the regulators trying to protect against? They play a really important role in ensuring that carriers have liquidity, that insurers that their customers are treated fairly, that pricing models are structured in a way that aren't creating disparate impact. And so when we first approached the product, there wasn't even a term InsurTech at that point. This was in 2012. So we were just kind of introducing a new insurance product. But the way we approached it was pretty straightforward. We simply went in and talked about the insurance product as what it should be. It's based on what the expected losses are, based on true miles driven, which has long been used in insurance products as a way of, and in California, it's actually one of the top 3 things that is considered to be fair. And so by kind of looking at this as a more fair insurance product from day one, you kind of speak to what the core of what they're looking for in the first place, which is how do you ensure that you're offering a product that is fair, is covering people in the right way, isn't creating kind of disparate impact. There's nothing about the product that is necessarily fundamentally against or different from what we've been trying to do for a long time. It's just structured and done in a different way. And so we were able to actually get the product approved in pretty short order based on that.
Excellent. I guess thinking about some of the challenges, roadblocks, and critical points as you guys were each evolving, relationships with other parties and specifically reinsurers often comes up as a consideration. So maybe Max, turning it back to you for a second, can you talk about, for the benefit of others, how you went about establishing your reinsurance relationship that was pivotal to the business, and what ultimately drove the decision to go with a single reinsurer versus multiple? If you could share some insights around that.
Yeah. So we learned pretty quickly that we would need reinsurance, which is kind of ironic in the title insurance world. Just as a quick primer, traditionally title insurance is a product that has almost no loss ratio. So that's a fancy way of saying that it basically has no risk attached to it. It's been a business of risk avoidance. It's focused on manual backwards looking research at the point of underwriting to make sure that no claims will arise later. And so we were immediately faced with this dilemma where our business, by the way, uses an algorithmic machine intelligence driven approach to instantly underwriting title insurance. We remove a bunch of the friction, frustration, and cost involved. We also dramatically reduce the amount of time it takes to close a mortgage as a result. But what we were doing was we were basically applying a PNC-like model to an industry that had never used that to operate. And so we had to go to the reinsurance market. This is another great example of where like those relationships I mentioned are so critical. Both of the reinsurers, if my recollection serves me correctly, both of the reinsurers we were very far along in discussions with were introduced to me by a soft wand, right? So like I picked up the phone and I said, hey, we need reinsurance. Did you guys deal with this? And he's like, yeah, we dealt with this. We've got this fronting thing, and we talked to reinsurers. And I was like, well, who are the good ones to talk to? And he gave me a couple names. Score who was the one who we partnered with, came out front because they actually, to Dan's point, actually looked at this like a first principles problem, right? They didn't take the traditional reinsurer's lens, which was like, okay, how do you price this risk and where can you offload it? And how do you mitigate it? They were like, well, this risk has never existed before, right? Like an algorithmic property characteristic specific probabilistic model that's being used to instantaneously underwrite title insurance. The funny thing about that conversation was it went something like this. I talked to Adrian Jones at Score, and he said, Asaf says we should talk to you because we should reinsure title insurance risk. He's like, but there's no risk there. Like, we're not interested in that because it's a low loss ratio. And we're in the business of better estimating and placing risk. And I was like, well, let me tell you how we're doing it. We use an algorithm. We're doing it instantaneously. And it's actually going to be a much higher loss ratio product than existing products. And Adrian was basically like, oh, so you're creating new risk that doesn't exist in the market. He's like, yeah, that actually would be something we'd be interested in. It was just kind of a fascinating discussion, right? Like where it's like, the more risk you're creating and the better you are at accurately estimating it and balance sheeting it, the more creative reinsurers are willing to get. And then the decision was made easy because Adrian offered to make a strategic investment in the business on behalf of Score. And I got to give credit to them. They were very early in believing in us and supporting us strategically. And that was what kind of sealed the deal. The reason we went with a single reinsurer was just because this was such a nuanced new slice of risk that we wanted a reinsurance partner who had the balance sheet capacity to manage our growth, but also who would make that strategic equity investment so that they were aligned with our long-term success and being willing to kind of suffer the volatility that would probably come in us building the business. And again, it's worked out as a fantastic partnership. I can't say enough good things about Score.
Excellent.
That's an interesting point in there also because you don't just choose the reinsurer, you choose the specific person. I don't know, anybody that met Adrian is one of the more thoughtful and creative, and he wants to understand. He's a first principle person, basically exactly as Dan said. He's not, oh, this is how it's done. And so it was Adrian first, and then of course Score that basically supported.
Totally agree. Yeah, completely.
Excellent. Dan, just turning it to you to talk a little bit about how you went about making the decision that you wanted to transform your company and move from what originally was a digital MGA to become a full stack carrier. I know a lot of other companies out there deal with that struggle in terms of, do they want to make the leap? Can you talk a little bit about that, and what advice do you have for those that are contemplating and struggling with this decision?
Yeah, for sure. And I think it definitely depends on the line of insurance that you're pursuing, whether or not it makes sense to actually be the full stack carrier. I also think that the receptivity of capital markets is a big part of it as well. When we started the company, in order to ultimately become the carrier, you not only either have to acquire it or apply for your licenses, which requires both a fair amount of capital and all of the operational kind of overhead and expertise necessary to make that happen. So we started as an MGA to get the product off the ground, prove that it works. Ultimately, that allowed us to go and raise additional capital to go and acquire an insurance carrier to do that. But I do think before you even get to that, you need to ask yourself the question, why is it that you're trying to become the full stack carrier, and what are the core reasons? We had very specific strategic reasons we wanted to become the insurance carrier. We wanted to ensure that customer experience, just like our pricing model was kind of built from the ground up with that sensor data as the core mechanism to deliver it. We wanted to think of the whole customer experience in the same way. So we wanted your claims experience to be largely instantaneous because we didn't want you to have to explain everything that happened at the accident scene. We wanted to do that from being able to reconstruct the accident data from your sensor data. So that as an example, you can really only change those parts of the experience by really building it yourself. And so for us, in order to make that happen, we had to become the full stack carrier, because asking another large insurance company or TPA or whoever to manage the claims process in the way that you want to is a larger endeavor. And so for us, it was a really important part of how we saw the future value of the company, our customer experience, and all of that. But it comes with a very high cost. I actually think in most cases, it doesn't make sense to ultimately become the full stack carrier. It's actually better to rely on great partners, really great reinsurers, fronting carriers, even primary carriers that can give you the infrastructure and support you need. That oftentimes I think is the best answer, because what you bring to bear in the market as your unique way of looking at insurance may not have to do with all of the back end stuff that happens in the insurance company. It may, and if it does, then maybe it makes sense to move towards that. But I would also say that thinking about this in stages and making sure that you're thoughtful about when is the right time is really important as well, because the amount of time and expertise it takes to really make the regulatory profitability and kind of operational side work is big. And so making sure you are thoughtful about that in the stages you go through is really important.
Excellent. Asaf, turning back to you for a moment, do you mind sharing with us a moment or two at Hippo when you were uncertain about the future of the company and some of the maybe the key challenge that you dealt with, and maybe how you overcame that?
Sure. Everybody that's been into entrepreneur, knows that it's never going, up and to the right. You have a lot of hits, and how you surpass them and how you manage through them is what basically builds value in the company. And that's how you build the resiliency of the business, etc. So that's one. The second thing, I have a saying in the company that you actually build IP when you're doing something tough and difficult, not when everything is easy. If everything is easy, then everybody can do it, and you don't build any IP and any capabilities. By getting stuck with something and figuring it out, that's when we build the capabilities and IP. Now, as a young company, there's basically several routes that you're getting hit. There is the insurance side, where finding a carrier, finding a reinsurance. The reinsurer decide to tack, and he doesn't want to take you because so you have a lot of these things. I always build the resiliency, so I have several reinsurance treaties. I'm using several carriers. Right now, we actually bought a carrier, which the transaction was closed earlier this month. You need to build contingencies because you can't be dependent on one point of failure. And you need to have, several options. So I never take one reinsurer, because we had a couple of cases where the reinsurer said, listen, we just decided not to keep reinsuring you guys. And my answer was, really, thanks for the call, but in 4 years and 10 months, let's have this call, because you just signed on a 5-year contract. And then they say, that's fine, you can sue us if you want. And as a startup, you don't have any other option. You have to figure something out. The last thing you have is go and sue someone. So every hit that you get is almost completely existential, and you need to to bring all kind of contingencies. That's one. The second point, which is I think also important, and people always don't think enough about, is that you need to really, really think what's the core capabilities of your company and where you build IP and what not. And there is a massive mission creep, and there's a massive, my co-founder wanted to build a CRM until you're asking why the hell are we doing it with Salesforce.com that have a couple of people that's all what they know how to build. So that you really need to think of what you're doing. But in a startup, especially in the insurance space, there are several components that you actually give someone else the right to touch your customers, and you need to transfer it in-house as soon as possible. I'll give you 2 examples. A call center. At the beginning, you're using an external call center because the entire company is 8 people. And while I have a customer and I need to have someone on, I need to have an agent on the call center, I can't hire. I don't have the systems. I don't have the calls. I don't have the phone systems. I don't have the CRM. So you're kind of using someone else. And then you're realizing that the customer, the person that actually touches your customers, which is in many ways the most important thing, is actually doing you a massive disservice. And it's not the kind of touch point that you want with your customer. That's one. The second thing is TPA. I think all 3 of us would realize, and Dan has, did the exact same shift, You cannot trust someone else to basically do the claims for you. The entire essence of an insurance company is taking care of people when crap happens. That's the entire product, basically. And if you waive that side to a third party who has his own incentives of, locking the transaction as fast as possible, minutes on call and things like that, as opposed to having the right customer experience and touch point, then it's a problem again. And then, so the point I'm making is that with time, you have a tendency, and you should start to take all of the important components and every touch point with a customer in-house rather than waiving it outside. And by the way, this is why one of the main points that why we decided to buy a carrier, because we had another middleman to help in the negotiation with a reinsurer who has his own opinions. That was one. The second thing, one of the biggest blocks for our growth was that our fronter couldn't raise money fast enough to accommodate our growth. And the idea was, in general, in business, is that the bigger you become, you get more scale, you get more scope, and you can get better terms. So if a standard fronting fee is, let's say it's 5%, I expected that when I'm passing a certain hundreds of millions of dollars in premiums, I'm going to probably pay 4% or 3%. And what happened is the complete opposite. I started to need to pay 6% and 7% and buy more reinsurance and things of that sort, which didn't make any sense. So it kind of forced us to take charge over our future and to buy more of the staff.
Interesting. I guess looking ahead in terms of what's on the outlook, how do you see talk a little bit about the insights you might have in where you see the homeowners insurance market heading, and can you give us a preview to the extent possible on what upcoming features can we expect from HIPAA?
Sure. So, the rough strategy for Hippo is I want to deepen up everything in the home. And I mean, there's all kind of flavors of home insurance. There's HO3, which is home insurance. There's HO6, which is condo insurance, which we're doing. There's DP3, which is an investment property, which we're doing. We have an HO5, which is an all peril product, which we're using for new home builds. We keep on thinking of where we can innovate and what else do we have, which is kind of in the region. We have a tendency to deepen up everything in the home and try and see what else can we do. We bought a company called Shelter, which is now Hippo Home Care, and we're doing something called telemaintenance. Every Hippo customer can actually call our call center, and if you want to vet some contractors, they're going to help you find some contractors. If you want to install a shelf, they're going to help you install a shelf. So we're deepening the partnership with our customers. We're deepening a lot of the stuff on the analytics and data. Everything with the context of helping customers. 75% of the US customers are underinsured after 3 years, because since you bought your home, you added a deck, changed the kitchen, turned the garage into a living room. Stuff happened in your home, but you never called your agent. Our aim is to make sure that our customers are constantly insured. So we're adding capabilities on that front. We have IoT devices. 80% of our customers are actually installing our kits that we're sending them. But we also have partnership with some of the bigger IoT device companies, SimpliSafe, Comcast, etc. So we want to deepen that component. I do believe in focus. So I'm telling you, I don't see in the next 3 to 5 years we're doing anything with auto or with any other line. I think there's not too much synergies between the different lines. And I want to, home insurance is a $100 billion market. Once I'm going to have 5-10% of it, let's discuss about me moving to other lines. I'm just not there yet. And I think there's a lot of specialization and focus on that. One point that I do think is interesting that we keep hearing about is bundling. And so especially for my board and a lot of investors, it's why aren't you offering bundling? And I want to treat it in two different things in the answer for that. The first one, I always like, I like to take a macro view. And the biggest proxy that I found for a macro unbundling was the unbundling that basically happens in banking. 10, 15 years ago, what used to transpire, you used to go to a Chase bank and you used to get the Chase credit card. You need to take your student loan, your auto loan, your mortgage, your money market account, and probably trade from a Chase account. And now it's United Card, it's SoFi for this, it's Wealthfront for that. And you know what? And the banks are actually doing well because they have other businesses that they're doubling down on. And I think that thing is going to actually happen as well in the personal lines. And also because Geico and Progressive are the ones that actually unbundling everybody, because in essence, they're a monoline auto. So that's something that happens as well, which I think is really, really interesting. I have one of my partners, IPO's president, Craig McCaffrey, always say that if you tie two rocks together, they don't float. So getting a crappy product on home and a crappy product on auto, tying them together doesn't make them a good product, makes them a crappier product. And I think people would have a tendency to choose the right products. So I think these are a lot of things that actually going to happen in the insurance. The last thing, which is COVID specific, I think COVID sped up by probably 2 to 3 years forward online distribution. People that were fearful of actually purchasing stuff over the web were throwing into that component. So we're actually seeing a rise of interest, and a lot more people that we wouldn't have targeted before are actually now customers. And it's an interesting thing. Our companies, all three companies in here, that's how they were set up. They were built to be digital first. They were built as technology companies that are also offering insurance. Moving basically remote was a non-issue. We're working remote part-time and, working over the weekend and doing the claims and all of that kind of stuff. So it wasn't a real shock for the companies, where for incumbents, it's a significantly bigger shock. Some of the systems are on-prem and stuff like that. So I think what you're going to see is a lot of these trends just accelerating in the future.
Excellent. Very great insights there. Max, I guess flipping the baton to you for a moment, can you talk about what's next in the world of title insurance and what your outlook is there, and how you believe the title incumbents will react to your market traction that you guys have had?
What's next in the world of title insurance? That reads like, if any of you guys are looking for some bedtime reading, I'm gonna write a memoir called "What's Next in the World of Title Insurance." You'll get about 2 pages before you pass out.
I think it's a headline for Wall Street Journal.
Yeah, right. Look, I think title insurance it's a misnomer. For title companies manage the closing of the mortgage, right? And what Asaf was saying about online distribution applies to our business like tenfold. These companies traditionally have operated through primarily brick and mortar networks. There's been a lot of sales through relationships, which obviously is still important to a degree. But in a world where consumers expect their entertainment on any device, anywhere in the world, on demand, they want to call a ride on demand, they want groceries delivered in 2 hours or less, they want to see a physician on a video visit and have a prescription cut to a pharmacy down the street, within 30 seconds of the visit. We have to be able to deliver this stuff instantly. And so what's next simply is everything instant. And that is what our business is about, right? We're not so much in the title insurance business as we are in the instant mortgage closing business. That's what our customers expect of us. Underwriting title insurance instantly was just the first part of that journey. So specifically what's next, we announced just yesterday, we've released a new feature that instantly reads closing disclosure documents. And this is basically the settlement statement that you get when you're closing your mortgage. And the old way of doing this was title companies did this thing. They referred to a technical term that they would use called stare and compare. They would have two monitors up. Your closing disclosure would come in from the bank, and they would be comparing on their screen the information they had in their system. It took an average of 80 minutes a transaction when it's most efficient. And our instant closing disclosure feature, which uses modern day machine intelligence, optical character recognition plus natural language processing, very sophisticated supervised learning model that's getting smarter with each file that passes through. It takes that 80-minute process and turns it into something that takes less than a minute, which is by the way, I had this meeting with our product team that was very funny, where I was like, they were like, how do we want to communicate the value of this feature? And we had a group of like 10 people, super smart data scientists, some of our marketing team. We were talking about how to write the press release. And I was like, guys, let me get this straight. How long did it used to take? And they're like 80 minutes. And I said, and how long does it take with our technology now? And they said, a minute. I said, so it's 80x faster. And as soon as I said that, by the way, all the technical people in the room were like, but no, we can make it faster. Like, I know it's a minute, but we can get it down to milliseconds. It's all in runtime now. And I'm like, guys, get it faster later. It's 80 times faster. Like one feature that we just released, right? So the future, in essence, of our business in the space that we're in is everything instant. A mortgage closes at the tap of a finger. On the incumbents thing, we're in a weird space, and I'd be interested in hearing Dan's thoughts on this too, because I think, you know, in the P&C world, there's probably a lot more worry about innovation. Our incumbent competitors, I continue to be surprised at how much effort they focus on trying to prevent us from coming into the market, and how little effort they spend on actually doing anything innovative, right? They're not filing patents. They're not hiring engineers. They're not hiring data scientists. They're not building defensible IP. They're not building long-term value. They're mostly just, they've got an army of lawyers that who are constantly like trying to creatively figure out how to prevent us from entering markets and prevent us from bringing a lower cost, faster, better product to the end consumer, which is protected and risk managed and all this stuff. So I don't see our large incumbents doing much in the way of innovation. I see them doing a lot in the way of what I would call anti-competitive behavior.
Yeah, maybe building off that, Dan, your thoughts with respect to that, and also how you see your world in terms of on-demand insurance progressing in the future.
Yeah, I actually think the two fit together really well. So, Max, a good question. I think in auto, it's a bit different, but it's kind of somewhere in between, where from what we've seen, almost all auto insurers are looking to actually create better products and use telematics in their product experience. The challenge is that software engineering, data science are not core competencies of the organization. They have traditionally outsourced that to large contractors that then integrate that internally. So all of the knowledge about how to build new products exists elsewhere. And it takes a long, long time to change a product fundamentally. So what I was going to say about this question, which I think is really interesting, on-demand insurance, not necessarily insurance using telematics. Telematics can enable on-demand insurance. But for the most part, what we've seen in the market is telematics basically being used as just another credit score, right? It's just another proxy that can predict risk that is backward facing and not necessarily looking forward to what the actual risk is and doing this in real time. So I think in many, and this is, again, Titus, to Max's comment, this is the challenge I think insurers face, is that they can't use their existing infrastructure, expertise, and organization to actually enable one of these new types of models. It's just a fundamental structural issue. So with respect to what's coming, I think in many ways we're in the early days of what true like real-time or on-demand insurance looks like, but I think it's starting to pick up. And tying this a little bit to Asaf's point, I think COVID actually accelerated the demand for this by 2 or 3 years. One of the things we discovered was, and I guess we've long known, is that optionality is critical for creating resiliency. Being able to control your own costs by being able to manage your own behavior and have that impact what you actually pay is really critical. And so we generally believe that as the world changes more and more rapidly, you need something that can adapt to your lifestyle. And so, insurance based on what you actually use, on a per mile basis or however you define it, I think is going to be critical to that. And a lot of the enablers for that are more and more kind of connectivity overall. So one of the things that we recently announced with Ford, a partnership there where we're now directly integrated with the vehicle, which is a more seamless way to integrate and offer our product. We do it with a device today. And I think as more and more vehicles and people have sensors kind of across all of these, it allows us to offer more and more kind of real-time options, which will accelerate the optionality for customers and lower costs overall, moving kind of the whole industry ultimately away from these kind of standard 6-month static policies.
Excellent. Thank you for that. I guess with the few minutes that we do have left, wanted to just open it up. I know you've each touched upon some of the acceleration and some of the advantages that you're experiencing in the current COVID environment. Share any additional insights you might have around that, and also if there are any struggles that you guys might be facing, whether it's internal or external facing. I'm sure we're all dealing with a different world in terms of how we operate. So any insights there you can share with the broader audience? Maybe Asaf, to start with you.
So two components. First one, home insurance has to do a lot with weather, a lot more than it has to do with a pandemic. And sadly, we're in a crappy year that there is a pandemic as well as a crappy weather. And everybody that lives in, specifically California, but you can actually talk about it on the East Coast. And there's a crazy storm going on in Louisiana, Alabama, and Mississippi right now. This has not been the best of years weather-wise. And then we're impacted by that component more than we're impacted by COVID and things like that. Now, specifically for COVID, even COVID had three different kind of phases. And I think all three companies probably seen it at the beginning. There was the first phase of COVID, and I think all three companies, I'm sure, without even talking to them, basically went to the trenches, decided how do we conserve capital? Do we need to let go of people? Because we didn't have, there hasn't been a high visibility on what's going on. And then we, at least in our business, we actually realized that on the sales side, on getting more customers, we're actually doing very well. And then we're attracting more customers from before, as we talked about. Now, on the claim side, there has been several interesting things. First phase, what we saw is there was an increase in frequency of the claims and a reduction in severity. And what basically happened is that our homes were never set up for people to live within them for 24 hours, 365 days. It's just like, we're not based on 15 different showers and 3 meals every day and just opening your fridge 5,000 times a day. It's not how the fridge was set up. This was not how these entire things were built. So at the beginning, but on the flip side, people were actually living in their house. So small leaks and things of that sort, they were actually handling them themselves. So there was an increase in frequency, but the severity went down. But now, after 6 months of this crap going around, the severity sadly started to go up as well, because the plumbing starts to collapse because it wasn't set up in a certain to a certain thing. And we're talking about small changes in frequency. Home insurance have something like 5% frequency of claims in a year, but increasing to 6% is significant from 5% because you just increase it by 20%. It's not a trivial thing. So small changes, and this is a significant behavioral change in how people are using the home, are having an impact. So there are pros that, more people are moving to online distribution. There's cons because we are getting some more severity on the claim side. Overall, we're wired and set up for these things. It doesn't scare us. We have enough cushion in the bank. We have great reinsurers that we work with. We bought an insurance company that can basically sustain that. We have a captive carrier basically in Cayman Island. We're wired for these things because this is what happened with the maturization of the company. You basically can sustain higher fluctuations of risk. And this is what we've been focused on the last year. Overall, I can't be more ready for this crap to be over.
Agreed. Max, anything to build off of that?
Yeah, I'd maybe just touch on some of the like people aspects that we've seen in our business. We have over 1,000 employees. Most of them were not enabled to work remote when this whole thing started. So that was a scramble. And I think the thing that we've learned, look, we've been very fortunate. We went through the same phase as Saf mentioned, where we had to batten down the hatches and prepare for the worst. None of us expected, I don't think anybody in the country expected the mortgage market to rebound as quickly. And quite frankly, it's on a tear, and it's probably going to be on a tear for the next several years. Our business is a function of how many mortgages are transacting in the marketplace, and we're also gaining share aggressively. So our business is doing quite well. I think on the people side, the thing I learned from this experience was you need it in crisis times. You need to be more iterative in how you communicate with your team, broadly speaking. So we started doing weekly all hands meetings with the whole company, right? And the second thing I learned that was really important, and I learned this from some advice I got from Sarah Fryer, who's an advisor to our company, was basically she was like, the most authentic leaders are transparent about the fact that they don't actually have the answer, right? Like we like to believe that the best leaders were always, certain of exactly what to do, and they had some big strategic plan. But, what we got more comfortable with was telling the whole company, we're figuring this out as we go. This has never been, no one's ever dealt with this before. It's probably going to get worse before it gets better. And the commitment we will make to you is you will always be the first to know, right? You're not going to hear about it last. We're going to tell you every week what's going on. We're not going to sugarcoat it. And that means that when you hear the news, it'll always be true. You'll be hearing it first and you will be in the know. And I was surprised at, we had to deliver some bad news before things got a lot better. And people were appreciative of us doing that iteratively and openly instead of trying to treat it through the lens of some grand strategic plan that we had figured out.
Excellent. Thank you for that. Dan, turning it to you finally.
Yeah. Max, a lot of what you just shared resonates a lot. We also moved to all hands every week. I think for a while you were doing 2 a week, one Q&A session and one overall presentation. But I can't spread more the value of just constantly communicating, especially when everyone's working from home. But the confluence of everyone working from home and something the world's never really, well, at least in our lifetimes, never really seen before. You just need to constantly communicate. And then I would say certainly authenticity and being able to say, we just don't have the perfect answer right now. Here's what we know today. Here's why we made this decision. And we're going to need your help to be able to continue to grow from here, is really critical. Because Asaf, to your point, I think, all companies at the very beginning of this needed to kind of take a step back, batten down the hatches. We had the same kind of thing. And then since then, the team has really come together in a great way. I think in large part because as you go through adversity together, you build great relationships and you can do something very special. So speaking from a business perspective, model perspective, we, I think auto insurance is pretty dramatically impacted. Of course, when COVID first hit, everyone stopped driving. So mileage went down 60% in the beginning of March. And for most auto insurers, this looked great day one because, they went from net margins of 5% to 20 to 25 or more. For us, our revenue went down by 30%. Because when you don't drive, you're not paying for your insurance. So our customers ended up saving day one. That is the purpose of the product. Our profitability actually stayed roughly about the same in solid place, and it has kind of since then. Driving has recovered, but one of the interesting things that we're observing is that there's kind of been this bifurcation in behavior where a lot of people who used to take public transit to work are still needing to go to work, and so they're now driving. So there's a large group of people that are now driving a lot more. And then there are people who used to drive to work who are now not going at all. So now you have a large group of people who are not driving at all. So if you look at the national average, we're actually back to where we were pre-COVID in terms of number of miles driven. Our customers are still, 20, 25% less than the overall market. And I think it kind of speaks to this kind of dramatic change in behavior. And I think what that has done for our mission has been pretty profound in that in times of crisis like this, you need to have that optionality to be able to create resiliency. And I'm just hopeful we've played at least a small part in helping people in that time save money when they use it in other places where they really need it. So it's been a really interesting time, and I think we'll continue to see what happens over time.
Excellent, thank you for that. And with that, I think we're right up against our allotted clock here. But
favorite slide, Stop. It's back.
I was waiting for that. I couldn't leave before seeing everybody's nice pictures.
I think that's Tony's doing there. But I wanted to, thank you all on behalf of the audience here. I think you've all provided some great insights today, obviously, and thank you so much for taking the time to meet with me today and have this dialogue. It's been great.
Thanks for having us.
Thanks for having us.
Yeah, thanks again.
Have a great day, guys.
Yeah.
With that, I'll turn it back to Brett and the InsurTech New York team.
All right, thanks, Rich. Thanks, Asaf. Thanks, Max. Thanks, Dan. It was really great to pull the Unicorn team together. I think that there were a lot of insights that everyone could have gained from today. And one really good takeaway that I had from the back and forth from Max and Asaf was that they work together, you know, and that's what the culture and community of InsurTech is all about. It's about working together to digitally transform the community and finding great people like Adrian to help with reinsurance. And when things are tough, coming together as a team and being the ones to share the information firsthand with the rest of your team. So I want to really thank the panel. Before we close, I just want to remind everyone of our next upcoming event, which is on October 29th, our InsurTech Virtual Matchmaking Expo. And really, the idea behind this event is to encourage that same type of ethos that you heard from the panel of working together and supporting each other. As an industry, we can be the ones that can do it. We don't need to be like the title insurance industry that has to use lawyers to hold back innovation. Instead, we can be like Max and work together and solve problems. So the idea behind our Matchmaking Expo is really to match people up. So if you're in a role now and you're looking for opportunities to gain new insights into InsurTech, find startups to be an advisor for, join their board, you'll have opportunities to meet great startups. We have already over 45 startup companies registered for Expo booths, and we'll have more. And the opportunities for those of you looking to change career paths for moving into a full-time role is also there. So just key highlights: 60 InsurTechs, 400 plus open roles. So those of you who are recruiting, we only have room for 500 people. That's a hard limit on our technology. So definitely you want to register right away. And I really just want to pull it all together and thank everyone. I want to thank our partners, InsurTech Connect and the Digital Insurance Agenda. Without you guys, it wouldn't have been possible to have such a great turnout to this event. And I want to thank our platinum sponsor, Ernst & Young, and Rich for being moderator today. Thanks, everyone.